25 or $30,000 can turn into break even or even a loss fairly quickly if everything doesn't go just as you hope.
Today, I'm super excited to be here with Jared Garfield. He is a real estate investor that has amassed more than 500 homes over the years. He started buying real estate with no money down in 1999. He's into land development, he's into vacation rentals. He's done between 60 and 70 deals of creative financing.
Well, you have to do things a lot differently today than you did when I started back in 1999. Because when I started, you could buy cash flow real estate almost anywhere and it would make great sense. Now you have to find the very best markets across the country.
I hear a lot of people say that investing in primary markets, that you might not be cash flowing, but you're betting on the forced appreciation. How do you weigh cash flow versus appreciation as an investor?
Can't necessarily guarantee that you're going to have appreciation.
What do you see as the most common mistake that real estate investors keep making?
You sell too soon when you should have held. You sell instead of 1031 exchange. You spend the cash flow.
Hello, everyone, and welcome to the Hospitality Edge podcast, where we bring together what we think are two sides of the same coin, real estate and hospitality, and where we aim to bring together entrepreneurs, investors, founders, leaders, operators, and syndicators in the vacation rental, hospitality, and real estate space so they can tell us more about their stories, the lessons that they have learned along the way, as well as maybe some of the mistakes they might have made so that we don't have to make those same mistakes ourselves. Today, I'm super excited to be here with Jared Garfield. He is a real estate investor that has amassed more than 500 homes over the years. He started buying real estate with no money down in 1999. He's got single families, duplexes, fiveplexes, eightplexes, everything you can imagine, and also some larger plexes in the mix as well. He's into land development. He's into vacation rentals. He's done between 60 and 70 deals of creative financing. You know, he's raised money. He's been a coach with Rich Dad Poor Dad. He has his own radio station. He's also the founder of the Six-Figure Blueprint, where he teaches real estate investors how to save in taxes and invest in real estate with some creative strategies that he's going to talk to us about further. So basically, this is someone that I'm very, very excited to discuss with today, because it's someone that knows a lot about real estate from multiple asset classes and from having done this for many, many years and having educated a lot of people on how to do this successfully. So all that being said, Jared, I'm super, super excited to have you today. Before we go into the story and learning more about how you got to where you are today and what you've learned, we always like to start with a question on, if you were to start today from scratch, you have nothing, you're not into real estate, but you have the knowledge, what would you do differently starting today?
Well, you have to do things a lot differently today than you did when I started back in 1999. Because when I started, you could buy cash flow real estate almost anywhere, and it would make great sense. The cash flow was great. You could buy. I lived in Metro Atlanta. I bought my first home for $72,000 and sold it like 3 years later for like $140,000, and it was a 4-bedroom, 2-bath house in a very nice neighborhood. And so that was very achievable back then. Nowadays, that same house would start at about 200 and probably $80,000, and so it certainly wouldn't cash flow very well because it wouldn't rent for $2,800 a month. Even this many years later. So now you have to find the very best markets across the country, and you may have to do some education and research and go into a market that's not where you live, and or you might have to house hack and maybe buy a duplex or a house with a basement apartment and live in part of the home and rent the other part of the home out. So things have changed a lot. If I were going to change one thing right now, it would be finding the very best market, because usually you have to invest where it makes sense, and that may not be where you live.
Got it. And so it sounds like cash flow there is one of the things that you are mentioning as to something that was easier to find. Cash flowing properties were easier to find when you started. Now you might need to go outside of where you live in order to get cash flowing properties. What do you think about when you look at like returns on an investment portfolio or an investment property? You have cash flow, you have the cash on cash return on an
Or at least
investment.
the pro forma says you
The
should.
performance says you should, but then you have, the appreciation. And what I hear a lot of people say, that invest in primary markets that maybe are already very expensive, is that, yeah, sure, you might not be cash flowing, but guess what? You're betting on the forced appreciation. So even if it's a cash flow negative property, you're playing more on the internal rate of return side of things. You're playing more on, the appreciation of the property. How do you weigh the two? How do you weigh cash flow versus appreciation as an investor when you're looking to decide what markets you want to be invested in?
Well, the first thing is you can't necessarily guarantee that you're going to have appreciation. We've had so much appreciation over the last 10 years that many markets are starting to correct. In fact, there was a chart that was posted on LinkedIn today that showed the top 50 metros across the United States, and more than half of them are actually retreating in value, some by as much as 10 to 12%, particularly in overbuilt markets like Texas and Florida, where a lot of builders are letting houses go just to break even and get out from under the debt, because their lenders are calling the loans due, and they're able to just sell them for what they have in them, and not take a profit. And many of these builders are actually buying down the rates to where new homes can sell at an interest rate of maybe 4.5%, which is about 2 percentage points better than what you might get on the open market, just because the builders are willing to take the profits that they would have made and use it to buy down the rate so that they can move the inventory that otherwise would be stagnant. So um, primary markets do tend to do better, but sometimes you can go out to suburbs, or you can go into towns of 300 to 500,000 people, and do much better from a cash flow standpoint. We feel like right now that short-term rentals perform much better than single family. Right now, if you buy a single family investment property, you might spend 230,000 and so your down payment's going to be somewhere in the 40 to $50,000 down payment range. With closing costs, you might be a little bit more than that. And so the return, if you're only making even $400 a month cash flow, $4,800 a year is not a great return on a $40 or $50,000 down payment. And that's exactly why I was saying that nowadays you might have to go to a different market. So, for instance, where I used to invest a lot in Metro Atlanta, in 2007, I could buy 1990s homes for 35 to $40,000 in that market and put 8 to 12,000 in rehab. Now those same houses are 250 to 280, but I can go to places like Davenport, Iowa, where I've been able to buy duplexes for 40 and $50,000 that bring in $1,900 a month in rent after doing about an $80,000 rehab. So now you're in an asset for 120 that might bring in 18 to 1900 bucks a month. But you have to look at where we are in the market cycle too, because with the inflation that we've seen, a lot of the C class assets are not performing as well as they used to, because a lot of the service economy workers who are paying $900 a month rent, they can't afford to live. And so we're seeing higher eviction rates. And that's made us move a lot of our portfolio from the small multifamily into the Airbnb areas, where we've made much higher returns and gotten better appreciation.
So there's something you said there. We can't always guarantee appreciation, and of course, like you said, it depends on where we are in the cycle. But is that something you've always understood, or is that like an element of your thesis nowadays, to don't bet on, or not hope for appreciation to be what's going to save a deal, and that's why you value cash flow more? Or where did you develop this understanding from?
Well, they always say that the number one rule of real estate is location, location, location. And that's because location drives value. Location drives appreciation. If you're in the best schools, if you're in the high growth area, you can even go to areas like Chicago that are losing population. They're in any city across the United States. You're going to have areas that are blighted. You're going to have areas that have higher crime, higher unemployment rates, higher vacancy rates, higher poverty rates, and those areas are not going to appreciate as well, but a lot of times that's where you'll find the very best cash flow.
Hmm.
We recommend that you never buy below C plus, but usually appreciation will by far outpace cash flow. So I might buy a single family house for 230 that only cash flows 400 a month, which appears a whole lot more attractive, you know, in the long term because of the appreciation. But people don't count on that. They go out and buy the duplex for that brings in 750 and say, "Well, I'm making double the cash flow," and that may be true, but that duplex may appreciate at 3%, whereas that B plus house that might be in a much better neighborhood and better schools might appreciate at 6% or 7%. And if it does, well, that's $14,000 a year in appreciation versus 2 or 3,000 a year in appreciation maybe on the other asset. And so you have to balance that, and balance how cash flow and the inverse relationship that cash flow and appreciation typically have.
Now, let's say, again, going back to you're starting over with the knowledge you have today, and you have to choose an asset class, and you're comparing, the way that the economy is today and all of that. You're comparing single family with multifamily with vacation rentals, and you have to pick a vehicle that you're going to use to build your wealth. What would be that vehicle? Or maybe that it would be a combination of asset classes, and you would start with one and then switch on to the next. Like, what would be that, asset class that you would start with, and how would you compound from there in order to build your wealth if you were starting out?
Well, younger people usually have to start with small multifamily, duplexes and fourplexes. And the reason for that is if you can buy a duplex that's only $140,000, your down payment is a whole lot lower. You might be able to get into that property for, $28,000. Whereas an Airbnb is going to be a lot more expensive. I have a lot of Airbnbs that paid 250,000 for. So instead of getting in for $24,000, my down payment might be $50,000, and with closing costs I might be at 60. But then the problem is if I have to furnish it and put another 30,000 in, I could be at 90,000 capital required for the Airbnb. But the Airbnb might make me $28,000 a year net cash flow versus making about 9,600 a year off of the duplex. So I might make 2 to 3 times the return, and it might be twice as good return on investment, and it's going to get better appreciation for sure. However, if I'm 25 years old, then all I have is $25,000 to put down. I have to start with the duplex, even though I might rather be in the Airbnb.
Now, what if you have the knowledge you have today, where you know that you can syndicate, you know that you can do joint ventures, you know that if you find a good deal, you can go out there, find investors, and find the cash. So let's say the knowledge wasn't, the barrier. You have the knowledge. It's just a matter of choosing where you want to apply that knowledge and deploy that fundraising effort, and invest in either, again, single family, Airbnbs, or multifamily. And the reason I'm very interested in that comparison, by the way, between the vacation rental space and the multifamily space, is because there's this idea of forced appreciation in multifamily, right? Where you can control to some degree a little bit more what
By
the
increasing the
the yeah, by
rents.
increasing the rents, by decreasing the cost, by increasing the net operating income, you can force how much more a property can be worth. And so as you're starting out and you're trying to like build that wealth, and you're trying to maybe repay your investors with an exit of a cash out refi or something, it seems like multifamily still wins. But I'm curious to know if that's also how you would see it, or if you think that, even if you were starting off, Airbnb short-term rentals would still be the way to go for you.
Some of it, again, it gets back down always to the individual situation. The short-term rental right now, because of the big beautiful bill that just went into effect in the United States, means that you could easily have 60 or $70,000 in bonus depreciation that can be taken in the first year that you own the property. That means you get to write off all of the furniture, all of the artwork, all of the dishes, all of the appliances. All that stuff can be written off in the first year. And they also, and you want to get with a CPA that understands this really well, but they also, I think, let you pull some of the depreciation that normally would be taken over a longer span into that first year. And so if you're making three, four, $500,000 a year, and you've got $100,000 a year tax liability, then one or two Airbnbs could negate the vast majority of your income tax. And now that money's something money that you have available to invest for your wealth building activities, instead of sending it to the IRS black hole that just siphons off your money. That maybe you have roads without potholes to drive on, which is great, but why not use that money to build your own wealth? So apartments can do some stuff with the forced depreciation. Buying foreclosures and single family has the same forced depreciation goal by picking up some equity, but that can be risky because if you're at a 10% interest rate and the contractor finishes 6 months or 8 months late and the materials cost more than you think they will, a lot of times $40,000 in equity could turn into $20,000 in equity, fairly quickly. And then if the market drops because you bought at the wrong time in the market cycle, then potentially, if the property is not worth what your comparable sales showed that it was worth when you bought it 6 months or 8 months later, you could end up being at a break even situation, which means if you had to sell the property, you'd sell it at a loss after commission. So, apartment complexes, if you're buying them with some vacancy and some deferred maintenance, you can clean them up. That's huge. But you also have to be very careful because you could be, if you're doing syndication, you could be doing a security without having a securities license. And so that it's important to get with a securities attorney and make sure you have your paperwork done right. And that can be expensive. But if you're doing a 80 unit or 100 unit apartment complex, it might be worth paying a securities attorney to make sure you draft the right documentation to be able to raise that money in the legal way, because there's no question that if you went in and renovated an 80 unit apartment complex that had 25% vacancy and had some deferred maintenance, by increasing the rents you might be able to sell that property 2 or 3 years later and make a $300,000 to $500,000 profit just in a couple of short years.
Now, when you look at the idea of like building your own portfolio, let's say on your own with your own proceeds from investments and from selling some of your own properties and reinvesting into further investments. And again, it's going to go back to, it's a case by case thing, but I'm curious, you specifically, um, if you were to go and compare, either you have the option of, just own 100% of what you own, even if it's going to go lower, because of course you need more capital if you're the only one investing, but at least you own all of it. So you might go maybe slower, maybe you end up with a smaller portfolio, but it's all 100% yours, versus you can go and start finding joint ventures and raising capital and having LPs and whatnot. Of course, surrounding yourself with the professionals needed to achieve that. Do you agree with the fact that, if you have the knowledge for it, that you should definitely eventually raise capital to go faster and build bigger and build more wealth? Or do you think there's value to, you know owning 100% of everything, even if it means having less at the end of the day?
So we've done some syndication type work and things like that, but I prefer to open buy a property through an LLC, and I partner on most deals that I do. I think it's a really good idea. I'd rather have 150 properties where I was a 50% owner than to own 75 by myself, because you're spreading the risk out a little bit. Usually you can rely on different talents. So I tend to partner with people who are really good at the numbers, can handle all of the paperwork, handle all of the taxes, and saving all the receipts and doing all the accounting and bookkeeping. I like to partner with that kind of partner who puts up capital, and then I like to be the operator because I can use all my experience to go out and find the very best deals in the best markets at the best timing, and then make sure that we can do superior renovations to really pick up big equity plays by doing that. And so, a lot of times you can partner with somebody who's too busy and maybe has capital, because there's two types of money problems: too much and too little. If you have too much money, you might not have the time to know where to place it. But if you can get with the right operator, a lot of times you can solve their problem because they need the tax advantages that real estate can provide, especially short-term rentals. So I think partnering is a great route. You just have to be sure that you can prove that you're competent and that you have the knowledge base. And I think it's good to start small and go do one deal and prove your worth to a partner, and then they'll trust you and repeat the process again.
Interesting. Now, when you look at the way you do partnerships today versus, let's say, your first partnership ever, what are some of the mistakes you have made that you are now very aware of that you take into consideration when setting up your partnerships for them to be successful?
Well, I think the first thing is in today's market, you have to shoot for bigger profit margin deals. I would much rather go in and do a 50 unit apartment complex that was going to make a lot larger profit than to start with a small single family house where I was only projecting a 25 or $30,000 profit, because 25 or $30,000 can turn into break even or even a loss fairly quickly if everything doesn't go just as you hoped, especially when the market's not going up and up and up. And so I think it's very important to make sure that there's enough profit in the deal that even if your worst case scenario happens, your worst case scenario is that you made a very small profit and learn from the experience as opposed to going in the hole. And a lot of the problems come with finding the right contractors. And even when you've had the right contractors that have done great work with you for 5 years, out of nowhere they can turn into the wrong contractor and do terrible work. Um, and and right now the labor pool is tough, and so you have to make sure that you really have good contractors that finish on in a timely manner at a fairly good price. If you're paying the top shiny truck contractors, sometimes their prices will be so high that they'll eat a lot of your profit. But if on the other hand you go in and use contractors that are quite affordable, they may end up looking like they'll save you money from the quotes in the beginning. But if they finish 6 months late, you may actually end up doing worse than if you had hired the shiny truck contractor to begin with. So that's where a lot of the mistakes are made, is in hiring the wrong contractor. You've got to make sure that you've you know accounted for things like extension fees with loans and things like that, and how long that hard money is going to be out, because it can eat your profits pretty quickly at 10% per month. And so sometimes it's a lot better to syndicate or raise the money and even pay cash, because there's been deals that worked out perfectly fine and were very profitable because we paid cash. But if we had done 10% interest rate, it would have cannibalized itself. So sometimes going in with the right partners to where you're maybe raise a little bit more money and you pay cash for the property could do a lot better.
When you say enough profit in a deal, and now you need even more of a profit margin to make sure you're safe, and so that it doesn't end up in a situation where you have something that you didn't saw coming and that took away all the profit. What does that look like for you when you're deciding to make an investment or not? Is it a minimum dollar amount in profit you need to have for the deal? Is it like you just add a margin of safety as a stress test, in terms of, like, whatever your scenario is that you're looking at, you'll just do a stress test with, like, a worst case scenario that's a certain percentage worst than, the original scenario you were looking at? Or how do you think about, when you're looking at deals, on a day-to-day basis, how do you think about what enough of a profit is for it to justify you pulling the trigger?
That's going to depend a little bit on market conditions. When deals are plentiful, and they're selling, because there's just so much demand and they're flying off the market. That's obviously a very different scenario than when things are stagnating, prices are dropping, people are buying properties 10,000 below list price, and it's going to take 4 months to sell instead of a week with 10 offers. But some of it's also going to depend on whether you're fixing and flipping, or whether you're holding for cash flow. A lot of that will depend. So a lot of times, if we can't make at least 25% return on the money, if we're flipping, we wouldn't want to touch it. You have to make at least 25%. And usually people might drop that down to even 20% if it's a really strong seller's market and things are moving really quickly. But when it goes, you have four different cycles. It starts with expansion when things are really exploding with growth, new companies are moving to the area, job growth, low unemployment, the expansion, new shopping centers, new roads. Then it goes into equilibrium, which means that, hey, it's not necessarily a buyer's market or a seller's market, but it's pretty good all the way around. Then it goes into decline, where things are starting to sell for, they're sitting on the market longer, they're selling for less than what they're asking. There's inventory starts to be plentiful. Many markets are starting to head into decline now. And then last is absorption, when the overabundance of supply is starting to get gobbled up. Things are at all-time lows. It's great to buy when you're in absorption, because you're headed for expansion and that you've kind of seen the worst of it. That's a great time to get in. But with that inventory starting to be absorbed and be taken off of the market, and so that would be like in 2009. You were pretty close to the bottom, but you could still get pretty good deals. But the market was starting to turn around quickly, and you knew you had to get out there and deploy the capital really quickly, because the opportunities were going to be gone um, pretty fast. And that opportunities haven't come back as good of a deal as what they were during that crash.
And of course, when you look backwards, it's a lot easier to identify where a market might have been in the cycle. But when you're in it, and especially if you don't have all the experience, it might be challenging to identify where in those levels of cycle a market might be. What pointers can you give to someone um, about understanding where in those cycles their specific market might be in? And is there one of those cycles where you would suggest someone should never invest in? Or I guess there's opportunities to be made at all levels of the cycle regardless.
Yeah. You're going to make great money potentially in any portion of the cycle. It just depends on what you do with your money. So if I'm in expansion, I want to be selling all the properties at the top. That's when you're going to get top dollar. And so that's a good time to liquidate and do 1031 exchanges into new opportunities. I- and if you want to buy and hold for long-term appreciation, then absorption is when you really want to buy, because that's when things are absolutely at the lowest. But a lot of it is driven by what's the reason on why I'm in this market cycle. So if I'm in Austin, Texas, and I know that I've had tremendous growth and that property prices have dropped by 15%, if I find a motivated builder who wants to sell me something below replacement value, and he just wants out and he's willing to sell and have done all the work for nothing for me, I might want to buy that new appreciation property in Austin, even though Austin is lagging and sitting there and slow right now. Because if the population growth and the companies moving to the area are still bringing lots of jobs, but I just have a temporary problem because they overbuilt for the supply that's there, but the future job growth, which would be shown by number of new people moving to the area, by number of companies that are currently hiring, by building permits. You want to go in and look at building permits. How many building permits per thousand are being issued? That's where you can really tell what areas of the country are growing. And if I'm in a place like Chicago where it's losing, I may not be able to count on a lot of appreciation unless I go to the path of growth and say, hey, people are not, there's still a lot of people who love Chicago, and it's still the third biggest city in the country. And while they may lose 60,000 people in a given year, that doesn't mean that there aren't pockets where you see lots of new subdivisions, lots of new shopping malls. You go to the area where the path of growth is, and you avoid where the blight is, where people are moving out. But you can still make good money even in a market that's going in the wrong direction if you're in the right hotspot.
Hmm. Very interesting. Now, going back to the previous point on the minimum profit you like to see in a deal before you pull the trigger today, based on the knowledge you have. You mentioned for a flip, you want to aim for a 25% return as the bare minimum. What if it's a hold? What if it's a property you're planning on holding? What do you look then as the bare minimum return that you consider good enough to invest in, while giving you that margin of safety that you were mentioning?
if it's Airbnb, I'm still looking for somewhere in the 25 to 30% return, just because the hassle of managing the cleaning crews and all the different things that you have to do. You guys take a lot of the work out and help with a lot of that. So I'm thankful for you. I think you're managing about 19 Airbnbs for us right now. And so I still want to make somewhere in the 25 to 30% return in the Airbnb market, because you can. And in the Airbnb markets, a lot of times you can go into towns of 250 to 300,000 people that don't necessarily have a lot of hotels. We've had a lot of success just buying in nice neighborhoods in big towns that have industry where people come for jobs, they come for work, they come for weddings, family reunions, funerals, college graduations. There's always construction crews, there's always traveling nurses. And we've done very, very well in those markets where we're making on $250,000 houses. A lot of times we can make $72,000 a year gross on a property that we only paid $250,000 for, where that house might only rent for $15,000 or $18,000 as a traditional rental. So, that's just a real good rule of thumb, but it just depends. I mean, if I'm buying and you have to go by asset class. So a C plus property, I want 12 to 15% cash on cash return minimum if I'm going to mess with the hassle and the turnover on a C plus asset. If I'm going into a B plus, then all of a sudden I might be fine with maybe like an 8%, 8%. If I'm in an A minus rental area that I'm going to get really strong appreciation, I might be okay only making $200 a month. Maybe I'm only making 3 or 4% on my money. But if it appreciates at 7% and it's a $300,000 house and I'm pulling in 21,000 a year in appreciation, that's going to by far outpace the profits I would have made on the cash flow on the C plus asset, as I alluded to earlier.
So it sounds like, if I understand correctly, when you talk about these returns, like this return benchmarks or minimum thresholds, you're talking about year one cash on cash.
Yeah, correct.
Do you ever?
And of course, they
Mhm,
get better usually, because obviously the principal pay down helps a little
exactly.
bit. Usually there's less maintenance after the first year and stuff. And I'll always assume that your first year you're going to perform. Don't get depressed if in the first year you don't perform as well as you normally would, because especially if you bought foreclosed houses that you renovated completely, no matter how nice the renovation is, you don't really know exactly what you're facing until you start running thousands of gallons of water through the pipes, and you start running the electricity all the time and the heater and all the time. So you're going to have a little bit more problems typically in year one, and you usually perform much better in year 2 and 3.
Do you ever invest in properties where it's a little repetitive as a question, but where the cash on cash doesn't look good anytime soon, but you're betting on the internal rate of return over, let's say, a 5-year hold period? Is that something you invest in, or for you, you just like the certainty of knowing that it's
I
going to cash
I
flow sooner rather than later?
No, I won't. I won't do it. I mean, if I can't cash flow, now I like multiple exit strategies. So for me, I want to buy something where I know I'm going to have 40 to 50,000 equity if possible, because I know that if I have to sell it because it doesn't work out, I can always drop the price. And even if the market turns and goes the wrong direction, I could at least sell it for break even if I have 40 or 50,000 equity, no matter what the market does. So I want multiple exit strategies. I like the idea that if I can't rent it out to a traditional tenant in a slow market that maybe is an Airbnb, it might perform a whole lot better. We've had properties that couldn't sell when the market stagnated, and we turned them into Airbnbs, and it went from negative leverage and possibly that we couldn't cash flow, or that we might have to sell the property at a loss. And instead of selling a property at a $20,000 loss, we might make 15,000 a year profit instead of selling it at a loss. So making sure that you've got multiple exit strategies is really smart. And I think an Airbnb is something you have to consider on all of your purchases. Is how would it perform as a short term or a midterm rental, or if it doesn't work as a traditional rental.
When you look back through all the deals you've been involved in, what's been the most common exit strategy that you've actually gone ahead and used? Has it been selling 1031s? Has it been cash out refinances? What's kind of been the common theme across most of your deals?
So we've done kind of a mixture of a lot of things because we've been a turnkey provider where we sell properties to investors that are looking to hold for cash flow. So that's really kind of like a flip, but we might hold it for 6 or 8 months because we'll put a tenant in and we might let it cash flow for a while before we sell it. Or we might decide to hold it in portfolio for 2 years so that we can sell it on a 1031 exchange, so that we can roll into other properties and not have to pay the tax bill that comes up. So 1031 exchange is always going to be better if you can, if you're a professional real estate investor. I usually recommend doing that, but that doesn't mean that you might not do a cash out refi to pull some equity out before you 1031 exchange it down the road, depending on how long you want to hold. But we usually recommend not holding a property for more than 8 years, because after 8 years there's a lot of your depreciation's already gone, so you've lost a lot of your tax advantages. And then the other thing is too, once your hot water heater's 8 years old, it's getting close to the end of its life. It might last 12 years, but if your roof is a 20-year roof, a lot of times they only last 15, so you're halfway through your roof life. And so if you can sell in 8 years, most of your buyers are not going to ask you for big discounts to replace any of the big ticket items, but you've also used up all your tax advantages, and so you can restart the tax advantages by selling at 1031 exchanging after 8 years. But you also kick the can down the road to the next buyer, to where you're having to do a lot less of the capex expenditures that can really eat into your profits.
That is so interesting. So would that advice still hold true? Like, would you still suggest people not to hold past 8 years, or has that changed? Because I hear a lot of people that talk about regretting having sold, and they're like, I wish I could have figured out a way to just not sell, and I would be so better off. So what's your take on
Those
that?
those people, Sebastian, are the ones that didn't reinvest. You regret selling when you didn't exchange it for another asset. But usually, if I'm 1031 exchanging, I might be going from one asset to two assets. And so my cash flow is always going to go
Mhm.
up because I'm rolling the equity from one asset into two assets. And usually the cash flow is going to improve when I do that.
What if it's a situation where it's not a real estate professional, so the 1031 exchange is not available, or unlucky, as I am here in Canada, we don't have 1031 exchanges here. So, like, would you suggest holding? In a world where 1031 exchanges don't exist, and is because of the 1031 that you think exiting, at 8 years max is the way to go? What are your thoughts there?
Well, I'm going to take this in a little bit of a different route because I'm licensed in this area as well as real estate. Sometimes when you get into your 60s or 70s, you get sick and tired of dealing with fixing toilets, or maybe you just get tired of having to have conversations with your property manager all the time. At some point, you want to be able to enjoy your life and relax. So even for professional investors, or even the accidental landlords that just have one or two properties that they moved out of and decided to keep them instead of selling them, you could potentially sell the property and then roll it into things like an annuity. An annuity could be a guaranteed income stream and could take away all the hassle. But right now there's products out there like Nationwide that are offering up as much as 30% bonuses when you put your money in. And so if you've got 500,000, you could be at 650,000 potentially. Now you have to check with a financial professional because these rates and terms change, but a lot of times they'll give you a guarantee for a fixed period of years, could be 10 or 12 years. And some of them may pay 8 or even 9% per year. And so they might give you a higher return than what the real estate is actually giving you, although you lose the tax advantages. But you can get you can get it to where the principal that you're pulling out is not taxed because it's already been taxed. And you're only taxed on the portion that goes that comes from the growth. And so there's some tax deferral there with an annuity. And so that could be one possible scenario for somebody that owns a lot of property and maybe gets kind of tired and wants to liquidate some of it. That could give you some guaranteed income for life where you're not worried about whether you're going to outlive your income. And sometimes people also get to where they know that their kids don't want to inherit the real estate. And so if you can't 1031 exchange, there are things like that. There's certainly municipal, tax-free municipal bonds that people can go into at times that can give tax free advantages. Cash value life insurance is another route where you could potentially pay the taxes on the real estate and then roll it over a period of 5 to 7 years into a cash value life insurance where the money would grow tax free. But the biggest advantage being that you could pull it out at retirement completely tax free. And over a 20-year retirement period, just being able to access that money tax free could save you six or $700,000 in taxes that you would have paid if you were in a qualified plan.
And that's something you are quite involved in as well, right? And to the point of, if I'm not mistaken, having that be one of the core things you guys do at Six Figure Blueprint. Can you tell us why you're so bullish on that strategy in particular?
Yeah, absolutely. We actually changed it to seven figure solution
Seven,
because we
okay.
realized that six figure retirement doesn't do much for anybody. And so we decided that instead of just hitting a six figure passive income through a combination of real estate and financial service products, we felt like it would be better to say, okay, so we need a seven figure solution. And the reason for that is most financial advisors will tell you that you can't touch more than 4% of whatever your nest egg is. So if you get up to $1.2 million in a qualified plan, if you're only touching 4% that you're pulling out, that's only $50,000 a year. The problem is that's before taxes. So if the government is a official partner in your 401k plan or a qualified plan, then they're going to take you to the taxes out. You're going to be left after 30% combined federal and state taxes as just kind of an average of what you might face in many states. You could be left with $35,000 a year, and that's on 1.2 million. And most people haven't saved up 1.2 million in their qualified plan. And so if you can't live off of 35,000 after taxes per year now, how in the world do you do it in 20 years with inflation and medical costs going up and things like that? And we don't know what the tax bracket will be in the future. It could go up. And so what we do is we say, look, what we need to do is you need to get at least 10 or 15 properties that by the time you're retired, the properties are paid off. They may be a combination of multifamily, single family, and Airbnbs. And then you may, when you get into your 60s or 70s, you might 1031 exchange 20 or 30 properties into one professionally managed institutional asset like a 100-unit apartment complex with on-site management so you don't have any headaches, and they're pretty much paid off by that point. And every time you're 1031 exchanging, so you're rolling it over, you're getting more cash flow and you're restarting the tax advantages because there's no tax bracket for retirees that says, oh, let's be nice to old people. They're living on fixed income streams. And so inflation hurts them worse than anybody else. So let's give them lower taxes. No, you're taxed based on what you earn. So the only way that you get a lower income tax rate at retirement is if your income drops to where you're living at the poverty line. Then if you're at the poverty line, you may not have taxable income, but that's not where we want anybody to be. So the whole goal is you've got to get to several $1,000,000, and it should be in different pots. Some guaranteed income that might come from something like an annuity, some some tax advantage income that could come from a uh, cash tax advantaged cash value life insurance possibly, and then the real estate, which if you're dumping the cash flow into a cash value life insurance policy for 20 years, it gives you enough money that if there's vacancy, you can cover the mortgage out of the money that you're saving. If a furnace blows, you can pull the money out of the cash value life insurance. All the while, if it's growing at, say, 5% conservatively, or maybe even perhaps higher, then potentially you're getting a lot more growth than you would if it was in a savings account. But it's growing tax free as well. And then that way, your tenants not only buy you houses, but they could potentially give you a six-figure passive income stream from that cash value life insurance. This is a strategy that the wealthiest families in America, like the Rockefellers, have been doing for more than 200 years.
Wow. Okay. Let's talk about that. So let's say that you're trying to coach someone and explain someone, what those stages are, what those steps are, what that process looks like from for them to go
Mhm.
from nothing to 10 to 15 properties that are paid off by the time they get to retirement, that they can do everything you just described with. What are the stages? What's the high level sort of process in terms of how you would advise someone to go about it?
Well, I think the first thing is you just have to pick a really good property that you're positive is going to have very good cash flow. Then you want to save that money. Our vehicle of choice that we like is typically a cash value life insurance policy with a reputable, strong company, and and they only make sense if you max fund it. There can be bad problems with IULs because the policies can collapse if you get too much face value of the insurance. So, like if you buy $2 million worth of cash value life insurance because you're hoping you could dump 60,000 a year into it to have it grow tax free, but you only fund it with say 10,000 a year. Well, that could be a problem, and if it's not set up right. But if you say instead, let me go ahead and get a million or a $500,000 worth of face value of cash value life insurance, but I'm going to max fund every possible dollar into it that I can, then you could be growing a large amount tax free. You can access it. It's because it's highly liquid. Usually 80 to 90% of the money is available at any given time. And so it's just a lot better than putting it into a bank account, because if you put it in the savings account or a bank account, you're likely to go out and pull it out, or you may move into a country club because you're making so much money off your real estate. You say, let's get rid of our $300,000 home. Let's go buy $1 million home because our cash flow makes it to where we can afford the payments. Or you buy the ocean going boat, or you buy a Ferrari or an expensive Corvette, when in reality, if you are saving the cash flow to make your real estate safer, you continue to grow your portfolio. And as that money grows in 3 or 4 years, you now have a down payment for a second property. So I might start with a couple of duplexes that might help me save $1,500 a month. That's 18,000 a year. Well, in 3 or 4 years, I could use that to buy my first Airbnb, maybe in the mountains, and maybe that Airbnb brings in 30,000 a year net cash flow. So now I take the 18,000 with the 30,000, and I've got $48,000 a year that I'm now saving. Well, easily within 2 years, I can buy a very nice second Airbnb, maybe 10 minutes to the beach. So now I have a mountain place and a beach place, both appreciating very well, both with the tenants paying the principal down, both giving me huge tax advantages. If I had $120,000 tax advantage in the first year that I owned two Airbnbs, then I'm going to be saving so much in taxes. I can now take the money that I would have paid to the IRS and maybe go buy another property.
Hmm. Interesting. That's uh, that's very very interesting. Now you've taught real estate to a lot of people. You were reach that poor that certified coach. You have your radio station show as well. What do you see as the most common mistake that real estate investors keep making, and that you see time and time again that you wish people could avoid?
Oh, that's a good question. I think the one is they cannibalize themselves. They live high lifestyles and they flip houses, so they have high incomes. And everybody's done this. I've done this. At one point, we did several hundred properties in Huntsville, Alabama, and I told my partners we need to hold these Huntsville properties. It's projected that within 5 to 7 years, Huntsville is going to be the biggest city in Alabama. It's going to pass up Birmingham, and these properties are going to probably double in value, and we didn't. So we were buying properties for 35 to $50,000, doing $30,000 rehabs, and then selling them for 120,000, and we'd make a 15 or 20,000 profit. And if we would have just instead held those assets, we figured there was probably $14 million in gains that we missed out on by selling them as turnkey rentals. And if we would have, and the hold time would have only been about 5 years. And so you sell too soon when you should have held. You sell instead of 1031 exchange. You don't save the cash flow. You spend the cash flow, and so and there's a lot of investors that do investing as their job. And so maybe they're making 3 or 500,000 a year, and that's what it takes to make the 300 to 500,000. But you've got to say, okay, every fourth deal I'm keeping for myself. Get to the discipline to where you live off of a little bit less instead of living off of 400,000, live off of three, and take the other money that you would have made and hold those assets, because that's what's going to build the long term wealth. Because uh, you never know when the market cycle is going to change. You never know how long your health is going to last. And one of the things we like with our strategy is by owning the real estate and having the cash value life insurance, there's also living benefits. If you become disabled, you can borrow against the cash value to live. If you have to go into an assisted living center at 65 years old with a stroke, you can borrow against the cash value to, if you have the right writers, to be able to live with dignity. So there's a lot of things that this strategy solves. And if you go to sevenfiguresolution.com, we talk a lot about the different aspects of funding a complete package that, that sets you up well for retirement, that includes real estate. And roiwealthwatch.com, we actually show a lot of properties that are available between multifamily, single family, and Airbnbs that are available, that people can use to build this strategy with.
Now, something that caught my attention about what you just said is you you talked about that mistake of having sold when you should have held, and that cost you a lot of money. So again, you see, like, that does keep coming back. I sold, I should not have sold, but of course in this case it
That's
was
a
a
lot.
timing thing. Um but 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 yeah, because you said it's about selling too early, right? The mistake there wasn't selling itself. The mistake was selling too early. Um but again, how do you know? And you got to understand those cycles, right? Where are we at in the cycle to know if I'm selling too early, or if I should hold still? um which is the tricky part, I guess. When you're in it, you don't know, right? When you're in it, it's a little challenging to have. What would be like a series of questions you would suggest real estate investors ask themselves before liquidating a property, in order to determine if they might be selling too early, or if it's the right time to sell?
Well, I think part of it is how many homes are still moving quickly, what percentage of the market are they selling at, and how much inventory is newly hitting the market. So, like for instance, there was a time in all the markets we were investing in where you could just go to huduser.org, which was the HUD home foreclosure site, and for some of our cities there would be 10 pages of foreclosures, and there were usually 10 houses per page, so there might be 100 HUD foreclosures. That didn't count Fannie Mae foreclosures, Freddie Mac foreclosures, VA foreclosures, any foreclosures that were traditional regular loans, uh, you know that were conventional. There will be just 100 foreclosures just among HUD homes. So when you start to see that you went from 10 pages to 7 pages, and then a few months later to 3 pages or to 2 pages, you know that the inventory is being absorbed and it's not continuing to hit. And that's a good signal to say, I better start holding on, because I'm not seeing a plethora, to use one of my favorite words from a Three Amigos movie. It's like, yes, I do. I have a plethora of foreclosures. If there's no longer a plethora, then you might realize that you probably need to start holding some of these properties, because you're not going to be able to replace them if you sell them.
Hmm. Very interesting. Now, let me ask you as well, when it comes to, like, what your life looks like today as a real estate investor. Of course, you do many other things than investing in real estate, but I'm curious to know, like, when it's such a large portfolio, right? Again, you mentioned you've amassed 500 properties. Maybe some have been sold. Maybe it's not like you own them all. And on top of that, there's partners involved, because you mentioned you like to go with, an LLC, bring in partners as much as possible. Once you've built such a portfolio, where is your time? How do you manage your time, basically, is where I'm trying to get to. Because you have what seems to be like a massive, infrastructure, or at least, a massive portfolio, that's for sure. And you have investors involved, and you have taxes, and you have, planning on what you're going to buy next, and what you need to sell, when you need to sell it. Like, when it is at such a large scale, what is it that you do to make sense of where you should be spending your time, and what your next move should be as a leader of that organization? How do you view your time, and where that time should be allocated?
Well, you have to have excellent property managers. That's important. And then, like for instance, with our Airbnbs, you guys with Angel Host do a great job of revenue management. So I don't have to be always looking at the services every day, wondering whether or not I'm charging too much or too little, how much money I'm leaving on the table, if I'm charging it too cheap so that I'm having a high occupancy rate, or maybe I'm charging too much and so my vacancy is real high. You guys also do a lot with optimizing my listings so that they're showing up on the first pages and having good titles, having the best pictures. And so it's really just about having the right people. I've got to have good property managers that are managing things well. You've got to make sure that the maintenance is really well maintained, because unhappy guests or unhappy tenants, won't renew their leases, and then you end up having vacancy, and then the turn costs can eat 2 years worth of cash flow, if you're not careful. So I think it's just having the right teams and the right people. And then once you get to the point where you feel like it's a little bit too invasive on your time, you have to exchange and say, okay, I don't want duplexes anymore. I'm going into only Airbnbs. And then once you get up to, too many Airbnbs, you may say, you know what, I want to keep one by the mountains and one by the ocean, because we use them a week each year, but I want to sell those and 1031 exchange them into a big apartment complex when I'm in my 70s. That's managed more like an institutional investment. And so, but all the way along, you're maintaining huge tax advantages, and that's the thing. It's not just for cash flow. At this point, real estate's number one biggest advantage is the appreciation over time. Over 20 years, it'll make almost anybody a millionaire. And the second thing is the tax advantages. The tax advantages are so sizable that if you're making $500,000 a year and you're not investing in real estate, you're making the biggest possible mistake, because over 20 years you're gonna lose $2 million maybe to taxation, and you could have kept a lot of that in your pocket if you would have kept the tax advantages that are available through owning Airbnbs.
So people, and what about what about the areas that you haven't been able to delegate, or that you have purposely decided not to because it's core to what you do as a real estate investor? What are some of those things where you do need to find time to do those things because you find that they are so crucial to the success of your portfolio?
Good question. I think that you can't delegate understanding the market cycle. You've got to do your own research and know where the market cycle is. You've got to do your own research on knowing which market to go into and which market to avoid, and when to come back to a market. That's important. So the market research, um, hand selecting the neighborhood and the property, walking the property. If it's a property, I want to choose the property, because if I don't walk the neighborhood myself, if I'm buying a $700,000 Airbnb, I want to make sure that I'm in the hottest area where it's going to really attract people. It needs to be close to interstates. It needs to be close to the attractions that people are coming to see, the conference centers or the museums or whatever it is that's your draw. If I'm in Orlando, I don't want to be 45 minutes from Disney World. I want to be 5 to 10 minutes away from Disney World. If I'm at the ocean, I probably want to either be on the ocean, walking distance to the ocean, or maybe a 10-minute drive, knowing that I can get a lot of people who will happily pay a lower nightly rate and stay completely booked because they don't care about being within walking distance. So you just have to kind of know those types of things. And if you don't drive the neighborhoods and stuff, you're going to really miss a lot of critical things that you get a feel for if you know what's going to give you the best possible returns. And same thing with rehabs. You have to get to know to where you know and trust your rehab contractors and know what needs to be done on the property so that you're not over improving, but you're also not under improving.
Sounds like it's all things to some degree acquisitions related, then, that you're not delegating necessarily, and you're keeping close to you. And in terms of the market research, what does that look like for you? I mean, is it just something that you do when you are thinking of opening and investing in a new market, or do you have sources of information at a macro country level that maybe get to your feed, get to your inbox, or that allow you to kind of do this market research on an ongoing basis, more organically, let's say?
We do. We have people like John Burns carries a lot of housing data that's very very good. If you're talking about Airbnb, then AirDNA is a good resource, and also oh, good grief. The one that you guys use at AngelHost, we don't use it because we go through you guys and you provide that, so we don't have to pay for it as a duplicate. But I know there's different softwares out there that'll tell you the vacancy rates and the occupancy
Mhm.
rates and different things like that. So those the some of those things are subscription models. There are a lot of good. There's a lot of good free resources too.
Got it.
I think my sound was lost for a second. There's a lot of good free resources out there as well. Bestplaces.net is one that you can gather a lot of data like on demographics or crime or different things like that. But
Bestplaces.net.
um,
Okay, took some notes. Very interesting. And last question, Jared. What's the question that I didn't ask that I should have asked that you think is fundamental and crucial for anyone investing in real estate to know?
you're really a good interviewer and you have very insightful questions. So I think you covered most everything, but I think financing is probably one that we didn't really talk a lot about. Right now, when rates are a little higher, the leverage doesn't necessarily make as much sense. So sometimes you could pay cash if you're paying 7.5% interest rate as an investor. The returns are actually not that much higher than if you paid cash, and the risk sometimes can go a lot lower. So I might consider paying cash when the interest rates hit 7.5 or 8% for investors versus using leverage. But I also think that it's important to consider that when you're negotiating on a purchase, instead of beating the seller up on price, sometimes it might be better to say, "Look, I'd like you to pay $10,000 in rate buy down." Because over the term of the loan, it might be better to get the more attractive rate than to beat them up on price, because a $10,000 price drop doesn't make much difference on your mortgage payment. But if you did 10,000 worth of buying down the rate, it might make a bigger difference over the term hold of the property.
So leverage. Just I know I said it was gonna be the last question, but this actually opened up a few more on the leverage side. If you still have some time, are we good with time? By the way,
Sure.
so
Yeah,
leverage.
absolutely.
I mean, I'll start with this generic question, and then we'll bring it down to earth. But how much leverage is too much leverage? Going back to exit strategies, going back to cash out refinances as a way to grow your wealth and portfolio when you're in that growth stage of it. You know,
Well, when I was in my 20s, four houses was too much leverage for me. I ended up having to run two early morning paper routes because nobody ever told me that if I had a whole bunch of mortgage payments in addition to my primary residence, that I needed to keep big cash reserves in case three or four tenants moved out at the same time. And I had to put money into the turn costs in addition to covering the vacancy and the mortgage. And that was something I had never thought about when I was 23, 24. I just kept thinking, well, I have enough down payments. I'm going to keep buying more and more properties. And so that put me into a pretty difficult spot for a while. So it's an individual question, but I think you should never use leverage more than if you have 6 months worth of cash reserves to cover the mortgage payments for all your properties. So I wouldn't keep buying properties if I didn't have at least a minimum of 3 months to cover all the mortgages on my property saved up. And so if you follow the advice that we always give, which is to save all the cash flow into like a cash value life insurance policy, where it's a little less accessible than the bank, gives you a lot higher return and grows tax free, then you should be a lot safer. But don't buy too many properties if you don't have the cash reserves to cover during a down market or a highly vacant market.
that's a very conservative. I mean, probably the right. I'm sure the right approach and the safe approach and the sustainable approach, but also sounds conservative and sounds um, less aggressive than a lot of the burr methods you hear out there, where you're hearing people finance the 100% of their next down payment with the refi on their last property, and so you're basically just piling up that debt on top of debt. And it sounds like you wouldn't advise that. You would advise for maybe a slower growth, but where you keep those cash reserves on check.
I love the Burr model. All I'm saying is when you do that cash out refi, maybe instead of going out and using all that money to go buy two properties, maybe buy one property, maybe buy something 50,000 cheaper and just keep the cash reserves for that next property so you've got at least 3 months. I mean, it's not a big deal to do, and you can negotiate some of that in the purchase of the next property. You might tell the owner that you want to have them gift the first 3 months worth of payments into an escrow account for you, that the seller is going to provide that. And I might even tack that on top of the price as long as it appraises. I would rather have the seller give me 3 months worth of mortgage payments at closing as some sort of concession and put it into my bank account than to negotiate on the price. I'd rather pay more and finance it, but have the money sitting there.
Wow. Okay. Interesting. And in terms of partners, just to close the loop on partners, because it also made me think about that when I asked you what questions I haven't asked you. Do you buy out your partners? Like, do you look at like an exit strategy as a way to, buy out your partners, and in that sense your partners are sort of like a financial instrument to some degree, where you're giving them a great return on their investment, but eventually they're no longer in the deal? Or is it something like where they stay as part of the deal for the length
Most
of the hold?
close friends. Yeah, most of my partners are close friends that we've been doing a lot of business together for 15, 20 years. And so they tend to stay in. I'll buy them out on a case by case basis if they need money for something. But most of them believe in the long term track record of growing the portfolio and 1031 exchanging. And so usually we try to hold them if we can.
Mhm. Very good. Very good. All right, Jared. Well, listen, this has been great. This has been, I've taken a lot of notes, and this was very, very insightful, and a lot of golden nuggets. You already shared some of the websites that people can go check out. Any other resources you might want to direct people to in terms of the things you have going on?
Well, if somebody wants to reach out to us, through one of the websites, either sevenfiguresolution.com or ROI, that's like return on investment. So ROIwealthwatch.com. I do have a whole lot of radio episodes that people can listen to at either. If you want to listen to Money Moves with Josh and Jared, we're on KRLD in Dallas, Texas, which is the biggest talk radio station in Dallas. We're on that, but you can also listen to Money Moves with Josh and Jared anytime on anywhere that you listen to podcasts.
Amazing, amazing. Thanks so much, Jared, for the time again. It was great to have you on, and looking forward to seeing you soon at the next conference.
Well, you're a great host, and I appreciate all the great questions, and I really love the job that Angel Host does.